Hello guys and welcome back to the channel. Today is Sunday the 10th of July 2016. I've just flicked back over to the Visual Capitalist website to see if there's any interesting visualizations, and we have one on Deutsche Bank. So I'm going to be doing a quick update on the Deutsche Bank situation because there is some headlines that are coming into the news now and again, and I'm aware that I've got a growing subscriber base, but a lot of people are at different levels of this journey and understanding what is going on in the marketplace. Now, for those of you that are obviously very aware of the situation and what Deutsche Bank are and what they represent, please do feel free just to turn this video off and check out something else that might be a bit more relevant for you. And for all those others out there that want me to explain to you exactly what this Deutsche Bank situation is all about, how very important this situation that is unfolding, and how this is the very first domino in the banking sector that is likely to trip the entire market if it continues on the path it is. And I don't see how it can get out of the situation it's in. So let's read what the report has. This report was uploaded on July the 8th, just a couple of days ago. The epic collapse of a Deutsche Bank, a timeline showing the fall of one of Europe's most iconic financial institutions. Deutsche Bank, DB, is the largest bank in Germany and one of the most important financial institutions in the world. The bank has struggled to recover from the financial crisis and has seen particularly tough times in 2016. Here's a look at the most recent developments that have taken the stock to a 30-year low. Deutsche Bank AG. So let's start up in October 29, 2015. Deutsche Bank announces massive restructuring plan after being hit by a record $2.5 billion fine for the LIBOR scandal. Along with that, they cut 9,000 jobs, which is 9% of the total staff for the Deutsche Bank. 6,000 external consultants cut and announced withdrawal from 10 countries. November the 5th, 2015, Deutsche Bank ordered to pay $257 million in penalties for doing business with countries that were under US sanctions at the time. January the 28th, 2016, DB announces a record loss of 6.8 billion euros for 2015. February the 8th, 2016, co-CEO John Crayan tells his employees that the company is, quote, rock solid, end quote. March the 11th, 2016, DB discloses that the national value of derivatives on its books is a whopping 52 trillion euros. I will go on to show you another visual capitalist diagram representing derivative markets and how these numbers relate to in scale and size to something that we can all understand in context. And I'll go on to that towards the end of this article. May the 16th, 2016, Berenberg Bank warns that DB's woes may be, quote, insurmountable, end quote, noting that DB is over 40 times leveraged. In other words, if anything goes wrong, it's impossible for Deutsche Bank to cover its losses. January the 2nd, 2016, two ex-DB employees are charged in an ongoing US LIBOR probe for rigging interest rates. Meanwhile, the UK's Financial Conduct Authority says there are at least 29 DB employees involved in the scandal. And obviously you can see the downward trend of just nightmare after nightmare. The losses are piling up. January the 23rd, 2016, Brexit decision hits DB hard. The bank is the largest European bank in London and receives 19% of its revenue from the UK. June the 29th, 2016, IMF issues a statement, quote, DB appears to be the most important net contributor to systemic risks, end quote. June the 30th, 2016, the Federal Reserve announces that DB fails Fed stress test in the US due to, quote, poor risk management and financial planning, end quote. July the 7th, 2016, Deutsche Bank stocks hit 30-year low, along with the UK pound. Today, Deutsche Bank stock is worth less than 10% of its peak value in 2007. Will the bank's reforms help to right the ship, or will it further crash under the weight of its own leverage? The epic collapse of Deutsche Bank, a timeline showing the fall of one of Europe's most iconic financial institutions. It's been almost 10 years in the making, but the fate of one of Europe's most important financial institutions appears to be sealed. After a hard-hitting sequence of scandals, poor decisions and unfortunate events, Frankfurt-based Deutsche Bank shares are now down 48% on the year to $12.60, which is a record-setting low. Even more stunning is the long-term view of the German institution's downward spiral. With a modest 15.8 billion in market capitalization, shares of the 147-year-old company now trade for a paltry 8% of its peak price in 2007. The beginning of the end. If the death of the Lehman Brothers and the Bear Stearns were quick and painless, the coming demise of a Deutsche Bank has been long, drawn out, and painful. In recent times, Deutsche Bank's investment banking division has been among the largest in the world, comparable in size to Goldman Sachs, JP Morgan, Bank of America, and Citigroup. However, unlike those other names, Deutsche Bank has been walking wounded since the financial crisis, and the German bank has never been able to fully recover. It's iconic because in 2009, the company's CEO, Joseph Ackermann, boldly proclaimed that Deutsche Bank had plenty of capital and that it was weathering the crisis better than its competitors. It turned out, however, that the bank was actually hiding $12 billion in losses to avoid a government bailout. Meanwhile, much of the money the bank did make during this turbulent time in the markets stemmed from the manipulation of LIBOR rates. Those, quote, wins, end quote, were short-lived, since the eventual fine to end the LIBOR probe would be a record settling of $2.5 billion. The bank finally had to admit it actually needed more capital. In 2013, it raised €3 billion with a rights issue, claiming that no additional funds would be needed. Then, in 2014, the bank head-scratching proceeded to raise €1.5 billion. After that, another €8 billion. The bank is now in the process of cutting 9,000 employees and ceasing operations in 10 countries. This is where our timeline of Deutsche Bank's most recent woes begins, and the last 6 months in particular have been fast and ferocious. Deutsche Bank started the year by announcing a record-setting loss in 2015 of €6.8 billion. Klein went on an immediate PR binge proclaiming that the bank was, quote, rock solid, end quote. German Finance Minister Wolfgang Schäuble even went out of his way to say he had, quote, no concerns, end quote, about Deutsche Bank. Translation: things are in full-on chaos mode. Doesn't sound rock solid, does it? Now the real question, what happens to Deutsche Bank derivative book, which has a notional value of €52 trillion if the bank is insolvent? And that's the end of that article. Now I want to show you this 52 trillion. And bear in mind the leverage of 40. So this is a previous visual capitalist diagram, which I do refer to quite a lot just because it helps people to understand the size of these billions, trillions, quadrillions, all these massive numbers, which, to be honest, nobody has a real grip of exactly what that means in the business world, in the commodity world, in the scale. So this actually gives you a fantastic representation. I'll quickly skim over this, but you can come into this website, guys, and go through this again, or I have gone through this in a previous video, which you'll be able to look up. Anyway, so each of these one squares is representing $100 billion. Bitcoin, which is outdated, obviously, and is worth more today, but for the purposes of keeping it in track with this representation, is roughly representing 5 billion. You got silver, which is representing 14 billion, and then you got the net worth of 3 high net worth individuals, all approaching 100 billion. You've then got the size of some very large companies, the largest in the world, Apple mainly being the biggest, with a market cap of 616 billion. Now I'm going to just scroll down to show you what the gold situation is for the world's total above ground gold reserves are estimated at 183.6 thousand tons by the World's Gold Council. Now, this is probably all not accurate at all, but they're projecting that it's worth $7.8 trillion. And obviously, that'll be a bit more today. So, all the gold in the world above ground, 8 trillion. And we are looking at a derivative book holdings of 6 times that. 6 times all the gold in the world above ground would be just enough to cover this one bank's derivative book. And I seriously doubt that it's 52 trillion. So now I'm going to get down to where the main point is, which is here. Now, obviously, each one of these blocks is representing $100 billion. Now, I'm going to scroll down, and this represents the derivatives for the entire banking system. And bear in mind, each one of these blocks is 100 billion. And remember, the gold was about this size. What's a derivative? A derivative is a contract between two or more parties that derives its value from the performance of an underlying asset, index, or equity. Examples of derivatives are futures contracts, forward contracts, options, warrants, and swaps. Banks typically use high amounts of leverage to attain these positions. Some derivatives, such as commodity futures, are traded on regulated exchanges, such as the Chicago Mercantile Exchange CME Group, in other words, the COMEX. And when they say regulated, we all know how regulated the precious metals industry is. They basically control where they want things to move. However, the majority of the derivatives are traded outside of exchanges between private companies and are called over-the-counter trades. Bear in mind, we're still going down. This is all 100 billion. Yeah, plus minus. This is obviously in dollars, and the report is in euros, so it's 1.2 or whatever it is. But just as a quick glance, just to get your head around exactly the scale that we're talking about here. So that's it. So the blue is indicating the lower estimate, and they are estimating that the derivative books globally are $630 trillion. So that's $630 trillion down to the blue line. Now bear in mind, this is saying 52 trillion euros. So on the lower estimates, roughly 10% of all of this lower end derivative is Deutsche Bank. But this is just the lower end. Now, they have a higher end estimate as well. The higher end estimate for the value of the derivative contracts is as high as 1.2 quadrillion, which would obviously make Deutsche Bank represent only 5% of the derivative market. The truth is that no one really knows the exact size of the market. And there we are, we're doubling it all again. And funny enough, at the bottom it tells you, hey, here's a little reminder, guys, that's what Bitcoin is. It's just that tiny little blip on the screen compared to all of this debt that has just been created out of thin air. And that's why the financial institutions, the huge banking systems aren't too worried about Bitcoin. Although it poses a threat to the banking system, in market cap, it represents not even a drop in the ocean. So there's a lot more people that actually understand Bitcoin but don't understand this derivative market. Now, if Deutsche Bank is a 5% stake in this huge bubble, this huge derivative expanse, and they are 40 times leveraged and are having serious systemic issues internally. It doesn't take a rocket scientist to understand that when the cracks start appearing in one banking house, the knock-on effect through the entire system seals the fate for everybody else, because every single bank have played the derivative game. They all bet against each other, they all bet upon each other's bets upon each other, and they bet upon each other's bet upon each other's bet upon each other. That's kind of like what they're doing with derivatives. It's just multiple bets piled upon multiple debts above other debts, betting on those debts. And once you get a quick understanding of the extent of these extreme numbers and what it actually means in terms of, companies, that should this one bank go down, which I'd imagine they'd do everything possible for it not to go down, but you kind of can't see how it can sustain the current path it's on. How do you sustain when debts have been piled from this era, debts have been added to this bank, yet profits and value have gone down? So they're betting on values always increasing, and there's more and more debt being added to their books every single year to cover for the bad bets and debts that they've had in previous years. Debt is just an unsustainable cycle, and it's a downward spiral. And this is the first official news that you're getting of a bank collapse. And what happens in a bank collapse? Well, previously we know what happens. 2007, 2008, boom, it hit. Bail-ins paid by the taxpayer. And what we know that is happening today, all the banks are issuing bail-in orders, which now means the governments and the people aren't going to be bailing out the banks per se via tax. They will be coming directly for any money held inside banks. And if we flip back to the visualization of this visual here, which is representing broad money. Now, broad money, according to the CIA fact book, the total value of the world's money is $80.9 trillion. This includes all the coins, all the banknotes in circulation around the globe, money market accounts, as well as all savings and checking and time deposits. So anything held inside of a banking system, anything held inside of your wallet, stashes, all of that represents 80 trillion, 81 trillion. So just Deutsche Bank alone would wipe out with a bail-in to cover its derivative loss. You're looking at what, 65% of the entire global broad money. And that's just Deutsche Bank. You got Goldman Sachs, you got JP Morgan, you got 10 other banks like this. And that is why if one bank loses its footing in the market, it's going to seal the fate for every other bank, but purely because of this leverage. It's really as simple as they only have €1 in their bank system for every 40 that they have out there on bets. So they've only got to lose 2 bets to hold negative equity, let alone the other 38 outstanding. And that will just ricochet, obviously, onto the other banking systems. Now, there's another little article here, which is Gulf News, 10th of July. Deutsche Bank lows and woes fuel existential fears. Long gone are the days when Deutsche Bank was seen as Germans' financial pride and joy. The price of the Deutsche Bank shares slumped to an all-time closing low of €11.44 on Thursday. This means they have lost a staggering 49% in value since the beginning of the year and are the worst performing stock in the blue chip DAX 30 index. Over a 10-year period, the drop is even more alarming. In May 2007, before the subprime crisis erupted, Deutsche Bank shares hit the giddy heights of more than €100 a share. When contacted, the bank did not want to comment on the development, which has repeatedly fueled speculation that Deutsche Bank could seek to raise fresh capital. Like most of the European rivals, quote, Deutsche, end quote, as it is simply known, has been battered in recent weeks by uncertainty related to the British vote to quit the European Union. In addition, the chronic weakness of the Italian banking sector is feeding investor concerns about the solidity of the European institutions. Inbuilt weakness. Such factors are hitting the sector as a whole, but in combination with what are perceived to be Deutsche Bank's own inbuilt weaknesses, the bank was recently described by the International Monetary Fund as a major source of systemic risk in the global financial system. Deutsche Bank, which has total assets of more than €1.6 trillion and a workforce of 100,000, appears to be the most important net contributor to systemic risks in the global banking system, followed by HSBC, Credit Suisse, the IMF wrote in a study in June. The US Federal Reserve last week revealed that Deutsche Bank US arm failed 2 sets of stress tests in a row. Quote, Deutsche Bank's decline has been spectacular, end quote, a source at a major European bank said. Since then, a seemingly endless list of scandals and malpractices has come to light, and Deutsche Bank has become engulfed in nearly 8,000 litigation cases all over the world. All these factors pushed the group into a massive loss of nearly €7 billion last year. Within the bank itself, the mood is grim. Less than half of the staff say that they are proud to be working for Deutsche Bank, according to a recent study published by the group itself. More and more people are quitting. On Wednesday, it was the head of foreign exchanges and emerging market debt trading, Amit Arnik, according to a number of media reports. Another Lehman, quote, there are very real concerns on the financial market about the bank. It's got a lot of problems, and it's also got huge exposures on the derivative markets. Many people are concerned it could turn into a new Lehman, end quote. One Frankfurt-based financial source said, speaking on condition anonymity. The US investment bank Lehman Brothers collapsed in 2008, triggering a global financial crisis, followed by a Eurozone debt crisis in the summer of 2011. The strategic overhaul will entail cutting 3,000 jobs in Germany and closing 188 branches. And there's quite a lot of banks that are actually cutting jobs at the moment, are closing branches, all to try and cut costs. And that's all I've got for you guys, really. You've got all eyes on this Brexit vote. You've got everybody pointing fingers at the UK for causing this decline in the marketplace, in the stock markets, in the currency markets. Whereas in reality, it's actually this Deutsche Bank that is causing this issue. The only reason the markets are in turmoil is because of this derivative market in the background that nobody really fully understands the size and the scope of what the impact will be should it collapse, should it explode, should it pop. And I say should because the only way it will happen is if the powers that be allow it to happen. If they don't want it to happen, they will just continue to keep piling and piling and piling debt upon debt upon debt, and create new ways of wrapping up debt into new forms of debt, because that's all they do is just wrap it up, and it's kicking the can down the road for the inevitable. The only way to hedge yourself against these scandalous activities is by removing your money from these banking sectors before they swallow up everything that you've got in there and put it into a much safer asset that will protect your purchasing power, which is gold and silver. Thanks for watching. Please do like and share and subscribe if you haven't. and please feel free to leave a comment.